Okay, so about myself, Dan. I got started in this entire business on the sell side in the investment banking industry. Started working at J.P. Morgan, sort of worked my way through the ranks there in the mostly in the fixed income side of things, which sort of gives you a good, side of the good view of the side of the street that you usually don't really see, from the inside so much. So I did that and worked my way through parts of the financial crisis. Kind of saw how things were unraveling, and then decided to go to the buy side on my own terms because I thought it was a bit safer over there. And then kind of took that knowledge and from what I learned on the inside and applied it on the buy side. Started building up a good track record. We did both equities and fixed income, and ultimately over the years started working more and more on the equities, exclusively U.S. equities and some European equities side. And now I manage money, got my own company, and I also have a big following in the Trade Alert service. So it's much less stress these days than working in the investment bank, I tell you that. So do you want me to just get started, Dan, or is there anything else you wanted to get out of the way?
No, that was great. Please go ahead and get started when you're ready.
Perfect. Alrighty. All right, guys. Well, thanks for joining us today. It's another weekday on Wall Street. We're going to go through the charts in just 1 second. Basically, the way I want to structure today's presentation is by going through a few slides and sort of the structure part of the presentation, and we'll go more and more as throughout the duration of or as the presentation proceeds. We'll continue to go more into live data and actual trades that have currently got on and things that I'm looking to do. So that's basically what the plan is here. Swing trading momentum stocks is what I do these days. It's how I manage money. That's become my thing over the years. I've found that stocks are actually a preferable asset class for a lot of folks from a time frame perspective, and what it sort of allows them to be able to handle the time frames and the movements a little better than some of the other asset classes that I've worked with in the past. So that's the quick intro. I talked about myself already quickly. Basically, just to recap, I cut myself my teeth at the sell side, then moved over to more of the buy side, and now am a money manager and advisor. Okay, so before we get started, I think it's always important that we kind of, particularly not just in life but also in sports and certainly in trading, it's important to kind of be honest with ourselves, where we are and what stage, and being aware that there's always room for improvement. I think that's very important. So I have these sort of 3 stages set up, and the stage 1 essentially is, and these are rhetorical questions you can kind of answer to yourself. The beginner will probably be in a situation where they're just reading and studying, and if actually never pulled the trigger. And quite frankly, that stage actually can be the best stage to be in because it kind of allows you to pick up stuff without any preconceived notions, and then be able to just execute on a trading plan that you learn from scratch a little bit easier. If those folks that haven't done this for 1 to 3 years or so, but are still kind of confused as what's going on, have an account, they're going through the initial sort of emotions of fear and greed and things like that. That's sort of stage number 2. So if you're in that stage, again, I think it's important to be honest with yourself if you are in that stage. And then the 3rd stage is sort of folks that have done this for 3+ years, but they're still losing money, or at least not making as much money as they would have liked to. So that too is a good stage to be in, because you're probably at the point where probably people that have stuck with it this long probably have a lot of endurance, so to speak, and are probably going to ultimately succeed in this business. So again, honesty in this business and like in many other parts in life is actually very, very, very important as far as I'm concerned. And I can tell you, over the years of having worked with many traders, different companies, both on the sell and the buy side, those traders that have this ability to remain honest with themselves ended up having a much higher success rate over time than those that continue to sort of try to cut corners, because it doesn't really work that way in trading. And if you do cut corners in trading, you'll have the SEC to deal with, and that's not fun either. So here's the agenda for today. We're going to go through candlestick patterns, and you know, we'll kind of start fairly basic to give you not so much to educate you from the bottom up, but when it's supposed to come out. So like, let's take, in the extreme example, you take Apple. You know exactly there's a few things to focus around: A, product launches; B, earnings; and C, any sort of affiliations they do. You know, whether it's in China or they buy another company or things like that. And most of those things are big things that we hear about, we can find out about through blogs, and there's a gazillion blogs that they're following Apple as a company, Apple at you know, from a corporate point of view, also from a product point of view. So all the information we want is probably there. So there shouldn't be any major surprises. So that takes a huge amount of risk off the table right away compared to some other things like you would have in certain commodities or even bonds, where you have geopolitical risks that can flare up anytime. Or also versus small cap stocks, for example, or even mid caps, where some of the stuff isn't as readily available. And then, of course, there is a risk of sudden up and down gaps, but again, we know when most of those things come, so that risk can be alleviated by basically just not being in the market when, say, Apple reports its earnings. At the same time, these stocks are great for leverage, right? So if you look at the broader market, and again, I'm going to be using Apple here, or even a Tesla as a good example from time to time, but Apple is the easiest one here at this point, just because everyone knows it in terms of the company and the stock, and probably has an iPhone in their pocket. So what's great about them also is they can use basically those stocks, not always, but in a good amount of times, as leverage to the broader market. So if you think that the broader stock market is going to rise over the course of the next few weeks or a few months, there's a decent chance that if you take one of these high beta momentum stocks, you know, one of them will correlate closest with the broader market and can be used as a leverage tool, as opposed to say using options or something like that. I'm not advocating necessarily as a replacement for options, but I'm just saying you can actually play the broader market along through those stocks as well. They're also wonderful trend following stocks, and I think there's something we said, but trend following is one of the most straightforward strategies, particularly if you know the ins and outs of it, in the sense that it actually takes quite a bit of discipline to be able to stick to the trading plan of a trend following methodology, but it actually can be one of the most lucrative ones, and particularly using stocks can be fairly straightforward in doing. So last but not least, and this is of course where we talk about charts here in a minute, basically these stocks also act very well from a technical perspective, and also I'll give you examples and real-time examples of all these things, and you'll see that these kind of stocks tend to react very well to technical support and resistance areas, which is really what we want to focus on for risk management purposes. I kind of touched on this part already. Basically, I think it's important when we look at these stocks, whether it's a Tesla, an Apple, or anything else, the corporate events and those of competitors, they are well known, but we must actually respect those dates coming out. So, for example, if you're a big believer in Apple and you have a big earnings report coming out from a trading perspective, it doesn't really make a whole lot of sense to hold the stock outright through earnings unless you hedge it in some fashion or another. But really, just believing that you know the outcome of the earnings report is quite a foolish way of trading. But the good thing is we do know when those events are there, and also those of the competitors. Also, the competitors are well known, so we know, for example, let's take a stock that's maybe a little bit easy to understand from a competitor point of view, like Chipotle, Mexican Grill. Any of the big restaurant stocks, you know, are a decent competitor. So those earnings numbers are important to be aware of, not just of Chipotle itself, but also of the competitors. But again, it's good to know. We know what the competitors are. We can understand those business models, and we do know when the dates are to be watchful of. At the same time, each of these stocks will, just like us having different personalities, and we have good days and bad days, each of these stocks tend to react well in their own respective time frames. So, and it becomes pretty clear when, for example, a time frame changes. So I'll show you examples of this shortly, but basically if you take a look at Apple, for example, sometimes it acts better with a time frame of a few days. Sometimes it's a better stock to hold for a few weeks or even a few months. And that's very nice to know when you look at a stock, because otherwise, with a lot of other asset classes, sometimes it's difficult to be able to make that distinction in when the personality shifts from one to another. use confirmation for all trades. We'll talk about that here just shortly. So let's talk about candlesticks. And again, like I said before, to me, candlesticks aren't so much the thing that I use to make the entire decision on a trade. I use them for risk management purposes because having worked routes to the ranks, myself to the ranks at both the sell side and the buy side, you sort of get the picture that there's more than just a chart in green or red arrows that goes into trading, particularly on the equity front. It really does matter what the macroeconomic structural backdrop looks like, and that's mostly referring to interest rates. We'll talk about there shortly as well, and then some of the other factors that come into play there. So, for terms of candlesticks, a lot of folks have heard about them. I think very few people fully understand them in the sense that what they actually are trying to tell us. So there are tons of candlesticks out there. I think that it's most simple to just use the ones that actually work. So if you were to go out there and get a book on candlesticks and read all 250 pages of the different kind of formations that can happen, you'll probably confuse yourself more than you should, because really there are only a few that really happen or show up a lot and give us a high probability setups on routinely. So we'll talk about those here shortly. So focus on the ones that work. The candlesticks themselves are very, very straightforward to read, which is to say, you basically can get two types of days: up days and down days. Okay, this is probably a bit oversimplistic, but basically, if you look at these two candlesticks here at the bottom right hand of your chart of this slide, you'll see the candlestick, the dark one, the black one here. You can see that's a down day. You had an open print here, a close print lower, but an intraday range that extended all the way beyond the open to close print range, right? So what that means is that basically, you have 4 data points here that are important. In fact, you have probably more than 4 data points if you consider also up or down gaps. But for the purposes of candlestick themselves, you have a high, an open, a close, and a low print. So that's the down day. The up day, of course, has an open, a close that's higher, and also an intraday range. A lot of times that extends both beyond above the close and below the open in this case. The most important parts of this high, low, open, and close relationship, to the extent that as it relates to trading from a multi-week time frame, is the daily close. The daily close is actually very important. Some people that operate in different time frames will tell you that the 30-minute bar or the 5-minute bar or the weekly chart, the weekly close is most important. From my point of view, particularly when it comes to these stocks, the daily close tends to be most important, and that's what we want to focus on. Now, getting right to the point that I think a lot of people are missing about candlesticks, and quite frankly, a lot of times about technical analysis in general, is that yes, you can use technical analysis in the traditional way, as do I, where basically you look at price, and price will tell you something about support and resistance and strength and weakness and all that kind of stuff, right? Both in absolute and relative terms, and we'll talk about the relative stuff shortly here as well. But the real power with candlesticks is that they're very visual. And basically, 60% of us have an easier time learning something or understanding a concept through a series of pictures. 60% of us, and it's arguably more than that. So that means that candlesticks, which are very visual, okay, they will be able to make it much easier for traders to manage their risk. And I'm saying managing risk specifically, I'm using those words specifically because I don't want this, I think it's important for traders not to be reward chasers. I think it's important for us to be risk managers, because really that's what this is all about. So that's very important to understand. 60% of us have an easy time. That's a right brain. It's a creative mind that's at work here. So if you look at this chart, at this this slide here, you can see that these candlesticks, and I'll show you these examples here, what all these means, what all this means a little bit more in just a second. But you can see that it's a lot more visual. There's a lot more information being represented here than you would on a line chart, which really would just be a simple line that doesn't really tell you anything, but a whole bunch of waves. So it gives you a clear visual representation of the price action on the chart. But even more importantly is this last point here. Basically, the price action really tells us something about investor sentiment, about investor emotions, and investor footprints. Okay, but I really want to focus on the psychological aspects here, because if we can understand what the rest of the market is doing in terms of its emotions, are they greedy, are they fearful, what's going on, then taking the opposite side, the opposite of that is a very high probability trade, and candlesticks actually allow us to see this, particularly if we use them in conjunction with a couple other tools that I will also highlight to you in just a minute. The other thing about candlesticks is, besides the fact that they just work, is that the formations, okay, the formations are very straightforward to see. So once you've trained yourself a little bit, it doesn't take a whole lot. Doesn't take a whole lot of time to understand what these things mean, you know, and how to use them. So it's all about decision making without emotions. I think that's very important. You have to find risk on these trades and very clear stops. And I took this example here of this person walking on this big cliff, because it's really something that I think is akin to what the candlesticks give us, and it's very much all about defined risk. So this person knows exactly where the stop loss is, unless they're wearing a jetpack or something. This is probably the point where they want to stop. So if the stock or whatever you're doing drops below this point, it's all over. So right here, you get a very clear visual signal where to get out of the position. And by the way, as I'm talking, I'm just seeing stocks starting to sell off here, just dropping below yesterday's lows. We'll keep you updated on this, and maybe there'll be a trade to show you in real time on that as well. So it's all about decision making without emotions. It's all about understanding the other people's, the rest of the market's emotions. So with that, let's have a look at some of the different types of candles that we can expect to come across that really actually work, as opposed to just textbook type of stuff that gives you too much information. So this is a very basic Doji candle, and instead of focusing all these different types of formations, let's just focus on the very basic Doji, which is basically an unchanged day. So you have an open print day. Let's say this horizontal line here is at $50. And the stock then on an intraday basis moves up to $53, but also moves as low as $44, but then goes back and closes somewhere near the unchanged line. And what that tells you is that there's buyer and seller balance, right, or basically investor indecision. Investor indecision, some sort of harmony, which we all know doesn't exist in markets for very long. So when you see a doji, particularly when you see a series of them, if you see multiple of those in a row, right, let's envision like 2, 3, 4 of those in a row, ultimately you will get a pretty decent move in one direction, and that's something to be aware of. So that's one of the very clear candlesticks to really focus on. The other one that I think is that happens a lot is the hammer. Okay, the hammer candle basically, and I'll show you an example of this in just one second. But the hammer candle basically gives you a bullish sign if it happens at the bottom of a trend. So it doesn't matter whether the actual body of the candle is filled or empty. In other words, if it was a down day or an up day. So let's just take the example here. It doesn't matter. So let's say you have a stock here that opened here. It closed up here, but on an intraday basis, it moved all the way down here. So let's say the open print was $50. The stock dropped all the way to say $40, and ended up actually closing higher at say $52 or $53. Okay, when that happens at the bottom of a swing, at the bottom of a trend, this is a really good spot to start looking to buy, to get into the long positions in stocks, bonds, commodities, currencies, whatever you're looking at, particularly if you have follow-through selling. Because again, the price action is clear. The price action failed down here, but think about it through the lens of psychology. What does it tell you? Well, it tells you that the bears, after already, selling the stock down for some time, came into this day, tried to sell the stock down on an intraday basis, failed miserably, and the bulls took over so much that actually ended up fully retracing the intraday sell-off, and actually even marginally closing higher on the day. Okay, that's what you call bear capitulation, and it's a very powerful thing, not only from a price action point of view, but again, if you understand what's happening through the lens of psychology, that the bears have basically capitulated, the bulls have taken over the ball, that tells you a lot about what there is to do here, and quite frankly, it's a pretty clear buy signal in many ways. So I think the example that I have, I'm trying to think quickly where the example is here. 1 second. Yeah, okay. So I'm going to give you the example here in the S&P 500 and the SPY here. The simplest one to give you is basically just the October lows, just because, I mean, there's no cherry picking here, guys. This kind of stuff shows up all the time on charts, and you can also see right now the S&P here dropping below yesterday's lows. See how that goes. But this is a really good example. Okay, so you have in this case the S&P 500, the SPY, you know, cascading lower here, and ultimately coming into this day here, which of course was October 15th. And on October 15th, what we had was the S&P 500, or in this case the SPY ETF, gap down. Okay, so it actually opened lower on the day. And then what it did is it tried to push lower intraday. And it did, right? But at some point, the bears were just absolutely exhausted, right here. And the bulls took over the game, rallied the market all the way back up. Didn't cause an up day, but it actually, the stock or the SPY actually closed higher than its open print. This was then followed by the next day with another choppy session, but the day afterwards, beyond that, the 17th of October, with a very bullish breakaway gap and thus confirmation buying. So this setup here was all predicated on having understood the bearishness or the bullishness of this bullish reversal candle, where basically bears capitulated. Again, you can look at it from a price action point of view, but I think if you look at it through the lens of psychology, it's just more straightforward to understand. So that's the real-time example here, or I guess the example going back a month and a half now on the SPY. If we now take this another step further, and you know, before going into more examples of this, I think it's important to make a distinction between day trading and swing trading, because each of us has their own personality, and not every type of trading will fit every person the same. So I think it's important to understand where we fit, and quite frankly, over the years, I have found that most people have an easy, and this is most, certainly not all, but most people that I've gotten to know over the years, from all walks of life, from all walks of education, different banks, different funds and everything, I can tell you most people have an easy time swing trading, i.e. position duration of 2 days to multiple weeks, than day trading. And I'll tell you why. So if you look at intraday trading, the case for it is over here. It takes a lot of intense focus. It's really not for beginners, although I know some people make it out to be. But at the end of the day, it's a very stressful situation, because you have so many setups happening every single day that could potentially happen. They may not be valid signals, but they may be almost valid signals. So it's very simple for people to overtrade. You of course have to be in and out of the market before the end of the day. Which can cause a little bit of anxiousness in itself. It takes a certain personality. Like I say, you have high frequency trading, high frequency trading algorithms in there that can push the market around, at no notice, and take you out of a trade for absolutely no reason. You have news that can push you in and out of the market very quickly, and all that can lead for a very choppy going. If you compare that to swing trading, it's sort of a really good sweet spot. There's no stress, or certainly not as much stress as you have in day trading, and there's very little boredom. So if you sort of compare day trading to long-term investing, the day trading stuff can be quite hectic. The long-term investing for a lot of people is actually a little bit too boring, and then they start, like, getting antsy about doing a trade, and so that's, that can be a dangerous thing to do as well for the wrong personality. But the swing trading is a really good sweet spot. 2 days to 4 weeks is my holdings period here. That's the comfort zone as referred to. It's a really good sweet spot if you think about it, considering that day traders, of course, have to be in and out of the trade intraday, right? So they can't really operate in any swing trading type of time frames. And then on the other hand, you have the investors, which usually have to hold stuff for at least a few months. So you got into a really good sweet spot with uncrowded trades where between 2 days and 4 weeks of trading time frames. I hope you guys can sort of make sense of that. The other thing is the time frames that I'm talking about here, and the fact that it doesn't involve a lot of stress actually fits people well who have daytime jobs or part-time jobs, or maybe retired or semi-retired, and they have other things they want to focus on rather than just sitting in front of the computer for 5-6 hours a day nonstop watching every single tick in the market. So the way I use this, I trade the markets with this is with very clearly defined profit targets and stop losses, as you'll see in just a minute here with the candlesticks. Candlestick patterns really help us weed through the best setups so that we don't have to second guess too much which is a better setup than which one is the best setup. So let's give you a few examples here, and I'm going to go again a little bit big picture, and then we'll start moving into more and more examples. Now these next few charts are I think about a year old, but I'm just giving you, I'm not cherry picking here just because I made those a little while ago, and I'm going to give you real-time examples here once we go through these. But you can see basically this is a stock called Walter Energy, WLT. What this stock did at the time is it had a very nice solid double bottom formation. This is, again, these are daily charts, so each one of these bars, each one of these candlesticks is 1 day of time frame. The stock then made a very nice consolidation period, but within this consolidation period had a lot of bullish candles that appeared, okay? And if you can't see it, don't worry about it. I'll show you this in more detail here in just a minute. But these bullish candles here ultimately led to this breakout, which one could have, had one been aware of these bullish reversals here within this consolidation period, one could have given a lot more higher probability to an ultimate breakout past this resistance area. And that's exactly, of course, exactly what we did, having seen that develop. First Solar, an interesting stock at the time as well. On the long side, you saw a stock here that using the 21-day simple moving average, which is one I like to use for sort of the near-term time frames. The 21-day moving average had a good time here over these months, where it reacted very well to various bullish and bearish candles. And thus giving us really good support areas, or risk management areas, as I like to call them, to where we can define our risk around them. And if nothing else, if you take nothing else away from this presentation today, I can tell you that the most important thing when it comes to trading is being able to define risk management areas. In other words, areas of support, areas of resistance, and it's important that these are areas and not absolute specific to the tick points, because the markets are not designed to give you that little wiggle room. Too many things can happen. Someone can hit the wrong button, a piece of news can come out, an algorithm can do something funky. So the room of error, if you are just literally setting extremely to the point stops and price targets, is very, very slim. So in order to give yourself a better chance of making money, you need to define support and resistance areas, and candlesticks help us do this very, very well, particularly if we combine them with things like some moving averages and other things that I'll show you here in just a minute. Another stock, Hewlett-Packard at the time last year, had a very, very interesting setup where in the September, early October time period, the stock had traded in an unusually tight manner. Very, very, weird price action for a stock like this. All of it was waiting for an investor day that happened in early October that broke the stock higher. That's this big green bar here. What then happened is once this occurred, and it also took the stock right back above its 200-day moving average, might I add, what I do is I go back and I use the important single-day moves up or down or whatever. I use them as the result, and then I go back and I see if the previous day's price action or the previous week's price action confirms the breakout. In this case, we had a lot of long bullish candles, hammer candles like I showed you before, and all those pointed towards a bullish price move actually happening. And of course, at some point, that rally happened after that investor day, and the stock took off, and we made a lot of money here very, very quickly for investors. Microsoft, this stock at the time had a very nice way of sort of moving higher in a stair-step way. Every time it moved higher, it made a higher low. It had very quick bullish reversals. Again, you'll see this in more detail here in just a minute when I give you real-time charts. And it continued to just move higher in a stair-step way. And again, the key was the bullish reversals that the candlesticks gave us, which through a lens of psychology told us that the sellers just weren't really there. The sellers had no real strength. They were just there, just enough to kind of take the stock off overbought levels, and then disappeared right away again once the slightest bit of buying action came back in. So all of this very, very clearly defined price action that we saw with the candlesticks. So let's look at the three-step process to the trade. And this is something I said at the beginning of the presentation. I actually do think that it's important, and this is of course a matter of style, not so much just something that I think is true for every single person. But on average, I have found that for most people, for most time frames, for most personalities, it helps that folks don't just look at a complete price action type of approach, but understand the broader market picture. So step one for me, I think it's very important that we understand the broader market structure. And that, for the most part these days, still means knowing what the central banks are doing. What's the monetary policy structure? Is it bear? Is it dovish? Is it hawkish? What's going on? Maybe there's also a geopolitical stuff in there you need to understand. So as far as it relates to for example, the current environment, I can answer you right now. We're still in a very dovish environment as far as the broader central banks go. For most parts of Asia, through the U.S. and in Europe. And then a geopolitical situation, we've got this whole entire situation with oil is not to be disregarded, what the geopolitical aspects there are. So that's the basic backdrop that we need to be aware of. And then step two, once you've got that down, and this doesn't take a PhD, as long as you just open the paper once a week or so and kind of clue in a little bit, you'll more or less see what the trends are in these things. And step two, you start looking, in my case, what I do is I start looking for stocks that are behaving well in the broader direction of the trend that is supported by the structure of the market. So in my case, as long as these central banks remain as accommodative as they are, although ultimately from a cyclical perspective the market will have to correct a little bit, but until it stops working, the markets will be well supported by this sort of rather silly quote-unquote easy money policy that we continue to see by the world's central banks. So that being the base case at the moment, you then start looking for charts for stocks that are trading well from a technical perspective in the direction of that trend. In this case, that means going higher. And then step three, and this is important, step three is where the candlesticks come into play, and I'm going to give you examples here in just 1 second. Step three is where the candlesticks come into play, and that's where you actually start going in and building the trade from a risk-reward perspective. You start setting your stop losses, your entry levels, and your profit targets. So that's the 1, 2, 3 step process. Very straightforward, not very complicated at all, and something I think that most people can do given their time frames, backgrounds, and the general sort of educational level. So let's go through a couple of these examples, and then I promise we're going to get into some real-time or current setups that we're looking at. This is Hewlett-Packard. Okay, we talked about the stock just before in a second, but if we go through the 1, 2, 3 step, you'll see that I have we look at the broader market structure. In this case, again, this was obviously the current environment, which is very dovish central banks. We look at a stock that from a technical perspective in step two is acting well. And we saw that Hewlett-Packard had a very nice V-shaped reversal here at the end of 2012, moved higher, and then ultimately when it corrected here in the summer, or I guess late summer 2013, it found support at its 50% retracement area. Okay, this is just selling off or correcting 50% of the entire up move that took place here. And then it started bouncing very nicely. So that's actually also, if you were to zoom in here, you'd get to that thing, the chart on Hewlett-Packard I showed you before, and it starts giving you a stock that looks to be ready to go higher, is supported by the broader market structure, and then you go in and start looking for candlesticks that support this thesis. So very straightforward 1, 2, 3 step approach on Hewlett-Packard is what I used in this trade at the time, and it made us a lot of money. First Solar, also a similar setup in the sense that we have the broader structure in the market that I told you before. From a technical perspective, then, what made the stock interesting, just to even consider looking at it, was the bottoming process. A stock that completely fell apart here in 2012 and parts of 2013, as it created into a July low or June low in 2012, I guess, and started really going sideways for some time. Once it started moving out of this sideways bottoming channel, we knew we had a stock that was being that had built a good bottom, and it was time to start looking for candlesticks to give us good risk-reward entry and exit signals. And I think this is the last one of these ones, and this is really an interesting stock that I would, from a long-term perspective, we looked at Walter Energy at the time, a stock that ultimately started breaking higher out of its past its long-term downtrend in 2013, which gave us a good reason to look on the long side for trades in the stock, and then using candlesticks to actually define our risk. So that's the 1, 2, 3 step approach there. Let's look at a couple of other stocks here in real time, so you don't see it. So you see, I wasn't just cherry picking this. This is stuff that happens every single day. So for example, I'm just going through a couple things here that I just know offhand. For example, you look at something like Biogen. Again, we're talking about a high beta stock in the sense that it's well known, people are following it. It's got a big name. It's a biotechnology stock, so by nature, by its very nature of the industry, it's an interesting stock. So if you look at the stock here, again, keeping in mind that the broader market still has the wind at its back from a central banking perspective. It does until it doesn't, right, is sort of the way I look at these things. And you see a stock that found a very nice bottom in April, all supported by very strong hammer candlesticks, by the way, that I showed you before. Ultimately made a very nice low here on October 22nd, also gave us a strong bullish reversal. All of this has the stock pushing up against a very clearly defined line of risk, which looks it depends how you draw this, right? You can draw this a million different ways, but let's just draw it very simply like this, okay? So as not to make it too confusing. Let's keep it simple because that's really the best way these things work. And you can see now, after topping out here, I guess in March of this year, we continue to push up against this line of resistance several times. And ultimately now, what the stock has done is, after gapping higher, after, I guess this must have been, if it wasn't earnings, that there was some other news here just a little while ago. I actually can't remember. I guess last week. It doesn't really matter. The point is the stock gapped higher, and it's now snuggling up against this defined line of resistance. So if we now consider the broader stock market structure, which is still supportive for the time being, particularly I would suspect into year end, some sort of Santa Claus rally could give this stock a pop past resistance finally, right? So what we now do is we look for supportive candlesticks. So until this breakout happens, let's see if we can find evidence going back for supportive movement. Yes, we have a whole bunch of higher lows. The stock's not trading above its moving averages. So in this case, I have the 50, the 100, and the 200-day simple moving average. These are just reference areas, right, that we want to focus on. And the stock is now really coiling up in here. And once we see a breakout, we would hope to see a clean breakout that basically would be continuation after this very bullish move that we saw here on I guess that was December 2nd. All this is being supported by a series of bullish candlesticks, so you see the pressure is really increasing against this line of resistance to the upside. Another stock that we could look at here would be, for example, some of the banking stocks. So for example, Citigroup, okay? This is not an immediate term call to action, although we had a very nice breakout last week and we did play that. But if you look at Citigroup, and you really have to peel back the chart, right? You can even make this arguably a weekly chart. Let's make this a weekly chart just so you can see plain chart, right? We'll make this a weekly chart. And you can see here we have a stock that on this weekly chart has really started coiling up against a very clearly defined area of resistance that dates all the way back to the 2009 highs. Okay, so this is sort of what you would consider step 2 in the 1, 2, 3 step process, right? We understand where we are from a big picture point of view, and we have a stock that's continues to push more and more weight against this line of resistance that goes back to 2009. At the same time, the stock has also given us a tighter range up here for let's call it the best year and a half plus actually, and ultimately now last week actually resolved to the upside. If you look at this weekly breakout we had last week, that's very, very, very bullish. If you now go back to the daily chart, the bullish price action here isn't as evident, but you will keep in mind what I just showed you on the longer term chart. But here too, you can look at this a little bit more closely, and you'll find that you have a lot of bullish reversals. We had the bullish reversal here, of course, on October 15th. Then another bullish, all sorts of bullish reversals where the stock kept pushing higher and higher and higher, and ultimately this led to that breakout that we had. I guess that was last week here too. And now we're just kind of trying to retest. So in the bigger picture, you have a stock here that should continue to move higher. Let's see, what else can we look at? We could look at, let's say, COF, just one that comes to mind in the financial space as well, since we talked about Citigroup. Capital One Financial, here you have what you refer to as an inverse head and shoulders pattern, okay, which looks something like this. Okay, if you guys are familiar with inverse head and shoulder patterns, this is no hocus pocus. You just have basically a stock that in many ways is again here too showing that it wants to move higher and push up against this line of resistance, all of this being supported by bullish reversal candles all over the place here, particularly down at the October lows. So before we look at a couple of more of these, I want to quickly get through an offer that I have prepared. Quickly go through this stuff here. I think it's important to understand when it comes to trading, and Albert Einstein said it the best when he said the definition of insanity is repeating the same behaviors and expecting a different outcome. And basically when it comes to trading, we need to have a plan. And if traders can't have a plan that they can stick to, or in other words, a plan that they can repeat without having to second guess themselves all the time, or a plan is here for trading in order for us to stick to our rules. And if we can't have a plan that's repeatable, it's very difficult to make money in the markets. The stuff I just showed you here today, with this approach using candlesticks for risk parameters, to set risk parameters and be able to stick to our rules, it's all made so that we can trade with as little stress as possible and be able to repeat the process every single day. And by so doing, really come up with a much more steady P&L curve through the years. So if you want to trade alongside with me, we're up about 17.5% year to date. My trade alert service, the way it's structured is that it's multiple high probability trading alerts every single week. So every single trade that I do, you get an immediate trade alert followed by an analysis right away with the profit and loss setups. You get a video every single morning and analysis throughout the day. You can get in touch with me directly if you want to through the messaging that's embedded. And we call it a holiday special. All this is included for 2 weeks for free, basically, is what we're offering right now, and that expires tomorrow. So if you go to vip.marketfi.com/free-study, it's right here, or you can call 1-877-440-9464. Be happy to give you the month of December for free. And by the way, the month of December tends to be a really, really, really good trading month. I'm going to give you some examples actually here right now that you can that I'm sure that we've already done this month for trading purposes. I think Dan just typed in the link into the chat box. And again, it's vip.marketfi.com/free-study. Again, it's for if you sign up there, you get 2 weeks for free here right away, and you get my entire full-on package every single day with the analysis, my full-on network of hedge fund managers and other institutional investors that I speak with every single day. You get all that fed to you. I'll keep you up to date with what I talk to people, what my lunch and dinner dates with these people, tell me, what research calls tell us. Every single thing is included, and of course, the portfolio. Again, we're up about 17.5% year to date. Tend to make somewhere between 10 and 30% on average. On any given year. Of course, there's no guarantee here, but that has been the track record over time. December. Let's talk about December real quick. I'm going to keep this here so you can see. You can still go to the link, which is right here. The trades I've done so far in December. First of all, Morgan Stanley. We bought Morgan Stanley very much based on the principle that I showed you before. If you look at the broker-dealer index, you can look at something like the XBD. Okay, that's the Amex Securities Broker-Dealer Index. You can see that this index had a very, very nice technical pattern here. That again, considering that the wind is still at the back of the market for the time being, that may change in January, but for the time being, we had a very nice higher low, and then we had a very clear coiling up here below resistance over the past few weeks, and ultimately a very nice breakout to the upside. The candlesticks here told us that within this consolidation phase, they were very bullish. So ultimately, a breakout gave us a good chance of actually occurring. So if we go back to Morgan Stanley, we made I think 2.5%, 3% here very, very quickly. Once this stock broke higher, it gave us the same type of pattern. Very nice to find resistance. We had this sort of bull flag pattern. If you don't know what that is, don't worry about it. But what's important to know is that the candlesticks lined up with a whole bunch of different things. They lined up with, in this case, the 50-day moving average. They gave us a bullish reversal here, this doji hammer candle, and all that led to a beautiful breakout. So had a very nice trade there. We did Goldman Sachs as well. Okay, Goldman Sachs had a very, very similar pattern, so we traded that one to the upside as well. We also traded Starbucks to the upside. That was a nice trade. I'm going to show you Starbucks real quick, and you can see here this too took the shape of a breakout pattern. Okay, but it could have been any pattern. What we did see was a stock reacting or acting very well, making a very nice higher low, continuing to act nicely here, consolidating in a very bullish fashion, and a lot of bullish candlesticks gave us the squeeze that we really need for the stock to continue to push higher. Now I'll tell you about a stock that hasn't worked out so far. Okay, in fact, I just closed it about an hour ago. I actually tried to go long OIH. Okay, OIH is of course the energy sector. This is how I roll. You know, I trade for a living. I'm not just telling you some funny stories that I see in the markets. This is real stuff. So there will be losing trades. So in the interest of full disclosure, because that's how I roll, I'll tell you that, for example, yesterday I tried to buy the OIH. Okay, this is the oil services index. I do think at some point these things will bounce. I guess they weren't ready yet. What we did see yesterday was a lot of negative divergence between some of the momentum oscillators. I'll quickly draw and say the relative strength index, and you'd see that from a price action point of view, the relative strength index actually gave us a higher low over the past while, in other words, not supporting this complete sell-off here. So yesterday we had an interesting bullish candlestick, and today, of course, we're still under a lot of pressure. So it doesn't look like that wants to happen just yet, so we wait a little bit more. On the other hand, I will tell you, in November we had a wonderful trade in OIH on the short side. Okay, so let's talk about this example, because I think it's very important to understand that you can make money both long on the long side and on the short side. So what OIH did, it developed after falling quite sharply here off the top in the summer. It started falling and then ultimately started moving into this consolidation phase, which took the shape of a wedge. And just the way the stock kept failing at resistance and what was happening in the oil markets from a structural point of view, the stock ended up standing a really good chance of faltering lower. So once it started breaking out of this wedge, we actually went short the OIH, made a quick 10, 12, 13% on the short side. So I guess today's move that we made, that I lost a little bit of money on, it's just a little bit of, let's call it mean reversion back to the trading gods. and that, of course, is just fine because that's just how trading works. So if you're interested in following me along, I'm happy to take questions, by the way. I'm not quite sure if I can see those questions. Let me have a look-see here. Let's see. But if you're interested to follow along, it's a vip.marketfy.com/free-study. I'm not sure, actually, John, or Dan, I don't know if I can see these questions. If there are any, happy if you could let me know. But that's basically what I would love for you to do is follow along and profit. Again, we're up about 17.5% year to date. Let me give you a couple other examples. For example, TLT, actually just now, literally a second ago, got an alert that TLT hit my price target. This is long bonds. Okay, I still think that the inflation expectations are too high. I do think we have this deflationary pressure, and the bonds, TLT, continue to power higher. We took profits, part profits on this yesterday, and I'm probably going to close this entire position here very shortly. But this is another good. So this is the long end of the bonds. Is sort of 20-year plus treasury bonds. And basically, from a technical point of view, aside from the fact that the market, after topping here in October, found good support, it continued to push back really nicely, and we had some very bullish candlesticks here and over the past few days that supported and continued to move higher, along with supportive oscillators, among other things. Let me draw this in here. And you can see yesterday we actually very nicely pushed past resistance after having very, very bullish reversals a couple days ago, late last week, let's put it that way, and on Monday. So that's TLT. Another stock that I think is setting up in this environment on the long side is, I'm trying to remember what the ticker symbol was for this thing. Was it Illumina? Yes, could be Illumina, might have been it. So this is a stock that looks interesting. Again, not immediate term. We do need to see a breakout first. But if you look at the let me quickly get rid of the momentum stuff because it's a little bit in the way. Okay, so what we have here is a stock that also made a very nice higher low at the October V-shaped reversal that actually managed to push back above the previous highs in the latter part of October, and has been consolidating ever since. Now, this stock certainly could start turning lower, but for the time being, the odds are that this stock will ultimately push higher past the 193, 195 area and push higher. So it's just a stock that I'm watching, and again, both the broader stock market support of this, the actual stock chart itself, and then of course the candlesticks have yet to give us the actual buy signal, but the candlesticks that we're seeing in the immediate term here are all very, very bullish, pointing that this stock could ultimately start pushing higher more. Now let me see what else. Another trading setup that I'm seeing is in Facebook. Facebook here, very similar to a lot of the other charts that I just showed you out there. Series of continuation higher lows. Ultimately, the stock broke past its resistance area here in the summer. It's basically, in the bigger sense, just been consolidating ever since. Okay, so that's kind of this type of move. But now what's happening, interestingly enough, is that the stock is starting to try and fill a gap that actually dates back to its earnings down gap on the 29th of October. So the stock hasn't really done much over the past few weeks, but this is an unfilled gap, so the stock gapped down, okay? And with a series of bullish reversals, the stock now ultimately, once it can sort of clear the, I'm going to call it the 7770 area or so, hopefully on a daily closing basis, it stands a good chance of being able to push into this down gap area and move towards about the $80 to $81 area. So that's another stock that ticks all three boxes of step 1, 2, and 3. In other words, it's being supported by the broader market still. Again, still, those things can change and they will change. A stock that continues to act well in candlesticks that are about to confirm, or maybe about to confirm, a fill in this gap, which could be a very nice trade to do for the holiday season. And speaking of which, by the way, guys, for the holiday season, I talked to a group of investors yesterday about this, and I think people are pretty quick in sort of discounting the month of December as a viable trading month, and I would say au contraire. Basically, what happens is December is marked by a couple of things. First of all, you do have less people trading. Of course, a lot of institutional investors have already finished, closed their books for the year, so you don't get those guys making any asset allocations for very little. Also, from a trading perspective, a lot of people I would suspect most people are not willing to risk their year anymore. Like, in my case, we're up about 17.5%, 18-ish% or so on the year. I'm not willing to make any big bets and swing for the fences. What I'm willing to do at this point is make a few cash flow trades. And cash flow trades or trades where you make a few percent with very defined risk-reward areas, and those setups happen most when you have a market that is more or less range-bound with an upward bias, or even if it's a slightly downward bias. And in the month of December, you tend to get that a lot. So if you look at, for example, the month of December so far, okay, we can look at the SPY, and today, of course, we're actually finally seeing a down day. But basically, what you see in the month of December, and I'm just going to go and start here with the past few. We have to zoom in a little bit more. In the month of December, you tend to get basically a tale of two tapes, where we can divide it into 3 parts just because today is such a good example of a down day. You tend to get a pretty good sideways move. Ultimately, at some point, you get a push to the downside, but then the bulls and Santa Claus will come back in and revert right back, maybe even back to new highs. So that's usually what happens, or a lot of times what happens in December. But the point is, the risk of a major outsized move in December is actually quite little. Now, it's funny we're having this discussion today because right now the S&P, or at least the SPY, is down about 1.65%, which is a down move we haven't seen in a long time. I guess probably since at some point in October, right? Nonetheless, the environment in December is such that there's a natural bid underneath the market, and it kind of keeps the market from falling apart. So you have very good risk parameters in place to be able to do nice and tight trades, such as, for example, the trade I talked to you about in Facebook here, where you could start filling this gap to the upside, such as trades that I think could hopefully release to the upside here in biotech land, in Biogen. These are all trades, stocks that are ticking all 3 boxes, and certainly from a candlestick perspective are viable and still have a lot of upward pressure, telling us that investors here are still more or less bullish, but not entirely greedy. In other words, otherwise we would see the flip side of this, which would then push the market lower. That's that. Then you can look at things like, and I'm going to wrap it up here in just 1 second. You can look at things like Chipotle Mexican Grill, which in many ways is also still giving us a very supportive chart, a lot of higher lows that are very bullish, a lot of tightness here in its chart. In other words, a very sort of concentrated chart with candlesticks that haven't confirmed a whole lot, but could confirm as a whole lot if the stock were to break, say, above the $667 area. In the meantime, you have a stock that is very well supported by previous resistance, now has become support. So as soon as the stock market feels like it wants to do the Santa Claus rally, this could certainly be a stock to watch and look for bullish confirmation breakout candles of the kind that we talked about before. So if you want to join me and profit along me, vip.marketfy.com/free-steady. You get the month of December for free, basically the next 2 weeks. Come along and join. We'd love to have you on board, and where it's all about low stress, high probability trading over at the Trade Alert service.